A sudden drop in oil prices has sent shockwaves through global markets. West Texas Intermediate, WTI, crude plunged 6% to 66.95, marking one of its steepest single-day losses this year. The dual drivers? A surprise supply surge from OPEC Plus and renewed tariff tensions following Trump's latest economic announcement. The message from Wall Street is clear. Plenty of oil, plus economic uncertainty. Bad news for investors. This isn't just a blip. It's a warning shot. Let's break down what's happening, why it matters, and what it signals for the months ahead. OPEC Plus shocks with supply surge. OPEC Plus, the alliance of oil-producing nations led by Saudi Arabia and Russia, stunned the market this week with an announcement to increase production by an additional 1.5 million barrels per day. This move was unexpected. In recent months, OPEC Plus had carefully managed supply to prop up prices, citing weak global demand and macroeconomic instability. So why the sudden reversal? Sources inside the group say it's a strategic move. Regain market share lost to U.S. shale and non-OPEC producers. Anticipate higher demand in Asia. Hedge against tariff-induced demand drop in Western markets. But the market didn't see it that way. Instead of confidence, the supply increase triggered fears of oversupply. And as traders dumped contracts, prices plummeted. Trump's tariff shockwave. At nearly the same time, Donald Trump reignited trade tensions by announcing a new round of tariffs targeting European and Chinese industrial exports. This wasn't about steel or aluminum this time. This round includes machinery, chemicals, automobiles, renewable energy components. Markets reacted immediately. Why? Because tariffs and slower global trade, and slower trade, weaker oil demand. Investors worry that rising protectionism could suppress global manufacturing activity, reducing the appetite for oil across key sectors like shipping, logistics, and production. Energy stocks were hit hardest. Major names like ExxonMobil, Chevron, and Schlumberger fell 4–6% in a single session, dragging the broader S&P 500 down with them. Supply. Glute plus demand anxiety. Market sell-off. You don't need to be a trader to see what's happening. When supply jumps and demand falters, prices drop. That's basic economics. But what's spooking investors is the scale and timing of these changes. OPEC Plus increased output before signs of strong demand recovery. Trump reintroduced tariffs amid fragile global growth. That combination created a perfect storm. Oil isn't just a commodity. It's a signal. Falling oil prices often precede broader economic slowdowns because energy demand is closely tied to production, consumption, and confidence. And right now, all three are wobbly. Global energy map in flux. This isn't just a U.S. story. Globally, energy markets are undergoing major realignment. China is importing less crude as it pivots toward renewables. India is buying more discounted Russian oil. Europe is still adjusting to post-Ukraine energy realities. West shale remains profitable, but wary of price swings. Add to that the strategic petroleum reserves still being rebuilt in some countries, and you have a messy, unpredictable market. What we're seeing is not just price fluctuation. It's a battle for control over the future of global energy. And right now, the battlefield is oil. Energy stocks sound the alarm. Markets don't just move on data. They move on emotion. And right now, the emotion in the energy sector is fear. The Energy Select Sector SPDR ETF, XLE, fell over 5% on the day. Small and mid-cap energy producers were hammered even harder. Volatility indexes tied to oil spiked to levels not seen since early pandemic days. This matters because energy stocks often lead market sentiment. When energy gets hit, investors start asking questions. Are we heading into a slowdown? Will inflation persist or fade? What does this mean for interest rates? Right now, no one has answers. And that uncertainty is poison to portfolios. Trump's play, strategic or risky? Trump's move to reintroduce tariffs is being debated across political and financial circles. Supporters say it's smart, puts pressure on foreign governments, protects U.S. industries from undercutting, signals strength heading into election season. Critics say it's dangerous, risks retaliation, weakens fragile supply chains, spurs inflation and industrial inputs. But Trump's own words frame the move differently. In his recent posts, he says, "The operation is over. The patient lived. America will be stronger, better, and more resilient than ever." He's selling tariffs not as pain, but as surgery, a necessary intervention. And now, post-operation, the market is adjusting. Whether it buys the prognosis remains to be seen. Geopolitics complicate the picture. Beyond economics, geopolitics are also playing a role. Russia is eager to boost exports to fund its Ukraine war. Saudi Arabia is balancing internal politics and regional power plays. Iran is ramping up output amid sanctions loopholes. Add to that an increasingly fractured OPEC+, and you have a situation where coordination is fragile. Nobody wants to be the first to cut production. Everyone wants to sell more oil, and that keeps prices low, even as risks rise. The consumer impact, short-term relief. Oddly enough, falling oil prices could bring some short-term benefits to everyday consumers. Lower gasoline prices, reduce shipping and delivery costs, cheaper airfare and logistics. But those benefits may be outweighed by broader risks. Market volatility, investment pullbacks, job cuts in energy and related sectors. In other words, cheaper gas now, shakier economy later. And if tariffs persist or escalate, those price savings could be erased by higher costs elsewhere in the supply chain. Where do we go from here? The path forward is unclear, but here's what to watch. OPEC Plus follow-up. Will they stick to the production hike or walk it back? Tariff retaliation. Will China or Europe respond with trade penalties? Economic data. Watch for PMI, retail, and employment figures. Energy earnings. Oil giants report next quarter. Will profits fall? Central bank signals. If oil-driven disinflation hits, rate policy could shift. Right now, markets are in a wait-and-see mode, and that's often where the biggest moves happen. Final thought. Oil is more than a fuel. It's a mirror. And what it's reflecting now is uncertainty, tension, and transition. OPEC Plus is overproducing. Trump is re-tariffing. Markets are bracing. And while consumers might enjoy a short-lived price dip, the bigger question is this. Is this a correction or the start of a new oil order? Stay tuned, because this story is just getting started. What do you think? Are tariffs the right move? Will OPEC Plus hold the line or break the market? Drop your thoughts below. Like, subscribe, share this before the next crude shock hits. Because the next move might not come from the White House or the oil fields. It'll come from the market.